Welcome back to Trading 360. It's time for the 360 round. It's FANG Friday. And we have Kevin Riley, Managing Partner at Exponential Investment Partners, and Ava Aji, Investment Advisor Representative at Gerber Kawasaki Wealth Investment Management. Thank you both for being with us. So Ava, I'll start with you. I know you're really thinking about FANG. You think the group is great, but definitely more for the long term, right? Tell me a little bit about your thoughts.
Nicole, thank you so much for having me. Great to be on again. As far as FANG stocks go, we've seen tech pull back really hard. A lot of that is due to high interest rates, inflationary periods. However, these are great companies. If you have the time frame to own them, I think that ultimately revenues will drive the earnings here, and you'll start to see them pick up over time.
So, Kevin, tell me your thoughts. Where do you stand on this group?
Well, the way we look at it here at Exponential is we constantly compare current prices to Wall Street targets and Morningstar numbers and the like. And if you look at any of these FANG names, we're looking at like 30 to 60% upside on some of these things, like Meta being the one with the most upside at about 58% upside. So we think they're incredibly beaten down. As Eva said, they're fantastic long-term companies to own. And the PEs are incredibly low, too. I mean, we've got 13 as a PE for FB and 22 for Google. So great time to buy them.
Yeah, so Kevin, let me just elaborate on that, because you said there'll be no misses allowed for Facebook in your notes. Yeah. And it's interesting how you're focusing on Facebook and Google more than some of the other FANG names. Why is that?
Yeah, well, I think Facebook learned a really hard lesson that last earnings report, and having the biggest dollar wipeout in corporate history, I just cannot imagine they're going to let that happen again. So their earnings are April 26, expecting $2.55 EPS and $32.5 billion in revenue. I would bet a large sum of money they will not botch that again. That's our feeling.
Ava, tell me a little bit about you're talking about this group and how they've built a moat, and really that's what really makes them these standouts, right? That's why we started with FANG in the first place, because they were something extraordinary. That being said, which of the group do you think is maybe in the best position, or maybe could go higher? Which one would you maybe stay away from?
Well, I really like Google and Apple as far as building a moat. They've been able to diversify. Amazon as well, by the way, because of the fact that they have the cloud. Amazon has AWS, Google has the cloud as well. And then Apple getting into services through their online shop. I think that's a really big push for diversification. Amazon, as we saw today, has news with MGM this week. So another area of business that they can continue to monetize, which means that they're less volatile over time. What I would actually stay away from is, right now, it's Facebook. The reason is because of the fact that I think sentiment has changed here. I think that as far as Meta goes, time will tell if that's going to be something that consumers are going to be interested in. But ultimately, as far as sentiment is right now, and as far as we can see, exactly right, they cannot afford to miss on earnings moving forward because of that sentiment.
Yeah, because they learned their lesson on the last one. Let's see what they bring to us next going forward. So you're a little bit different on the Facebook play, but seem to be in agreement on some of the other names like Google, for example. Then, Kevin, what about a name like Netflix? Your thoughts on Netflix?
Yeah, clearly the market leader in their space. It's trading down around $375 right now. It's got a price target north of $500 on it. You know, this thing has given up all of its gains from the COVID increases it got. So we think that in the long run, once again, this is a great one to own. And, you know, at some point, these stocks are all going to bottom, and we kind of think that they have at this point. I mean, there's been multiple compression going on for 6 to 9 months at this point. And all of these stocks basically are not reliant upon what the current 10-year treasury is. You know, it doesn't matter if the 10-year treasury is 2%. I mean, that's not going to affect Amazon or Google's business one iota.
Right.
So we think to some extent, the baby has been thrown out with the bathwater on these companies. And, it's really just a question of when that multiple compression is done. And, that's a tough call, but we are starting to think
Right,
it's
right.
done.
Okay. So you do see a lot of potential for the group. You think some of them have bottomed. Ava, you said in the short term you like some other areas, right? That these names are good for a long-term play, but you were saying financials, industrials, looking for value. Tell me a little bit about what you're looking for here in the short term, quickly.
Yeah, absolutely. So when we have high interest rate periods or high inflationary periods, some areas that will benefit in the short term, and it's kind of a rotation out of tech for the short term, are industrials like mining companies that we're looking at as well, financials like Silicon Valley Bank, Charles Schwab, all those benefit from higher interest rate periods. So as far as short-term plays, that would be a great way to look, but for long term, absolutely right. We still love tech. That's going to drive efficiency for the long term.
Yeah. Thank you both very much. It's great to see you. I really appreciate it. Love FANG Friday. It's always a good discussion because people have these in their portfolios, whether they like it or not, right? I mean, it's just in so many of the indexes and such. So, and we've seen some of these beaten down. So Ava Aji and Kevin Riley, thank you very, very much. Good to see you.